Estimating dividend based on dividend payout policy. Constant dividend. Constant dividend is like preferred stock, where the firm will pay a constant dividend forever. It is computed using the perpetuity formula. Constant dividend growth. In constant dividend growth, the firm will increase the dividend by a constant percent every period. Suppose your currently you are a company company is providing $2 dividend per share. In next year, they are increasing the dividend payout at 5%. If the growth continues 5% in every year, then it is considered to be constant dividend growth. So if currently your dividend payment is $10, then at the rate of 5% growth in year one, your dividend payment will be 10.55, and year two, your dividend growth will be 5% times 10.5. So it will grow in the same growth percentage. So the price of the stock is computed using the growing perpetuity model. Supernormal growth. Dividend growth is not consistent initially, but settles down to constant growth eventually. Suppose currently the company pays $2 dividend. After year one, they increases the dividend payment at 5% growth. At year two, in year two, they increase it to 10%. At year three, they decrease it to 8%. So the ratio of or percentage of growth is not same for supernormal growth. It can be decreased, it can be increased. The growth percentage is not even here. Zero growth. If dividends are expected at regular intervals forever, then this is a perpetuity. And the present value of expected future dividend can be found using the perpetuity formula P0 equal to D by R. In zero growth rate dividend model, the dividend is paid in a constant rate. There is no growth of the dividend payment. If company pays dividend $2 in year one, it will continues $2 in every year. So there is no growth of this dividend in zero growth rate model. So we can see an example for zero growth rate. Suppose a stock is expected to pay a $0.50 dividend every quarter, and the required return is 10% with quarterly compound. What is the price? So according to the formula, your dividend payment is 0.50. So D for 0.50, and required return is 10%. Since it is quarterly, then 10% should be divided by 4. Then 0.50 by 0.025. So your current market price of the stock is $20. So if you invest $20 in stock, then you will receive 0.50 dividend every quarter, and record return is 10%. So it is so normal and easiest way to calculate using perpetuity formula. If investors see that the company pays a specific or constant dividend in every year, then they can calculate the share price of the stock based on the future cash flow using this perpetuity formula, and they can invest in this stock. Dividend growth model. Here we can see formulas for dividend growth calculation based on dividend growth model. Here, D0 is first year dividend, G is growth rate, R is required return, D0 is current year dividend, G is growth rate, R is required return, and D1 is first year dividend. Suppose Big D Incorporation just paid a dividend of $0.50 per share. It is expected to increase its dividend by 2% per year. If the market requires a return of 15% on asset of this risk, how much should the stock be selling for? So now, here we can see the company currently just paid dividend $0.50, and it will be increased by 2% in every year. Required return is 15%. So what is the price of the stock? So P0 equal to D0, current dividend, multiply 1 plus growth rate G divided by R, required return minus growth rate. So your current dividend, here it mentions just paid a dividend. That means it dividend in year 0 in current year dividend 0.50. The student may confuse to find out the current year dividend and dividend in 1 year. In example, you'll always see when it mentions just paid a dividend, pays a dividend, then it is considered to be current year dividend. When it mentions that next period dividend, year on dividend, then it is considered to be year 1 dividend, and it will be mentioned as D1. So D0 is 0.50, 1 plus growth rate 2% divided by required return 15% minus growth rate 2%. So your current price of the dividend is $3.92. So if you buy stock investing $3.90, you'll receive $0.50 dividend currently, and 2% increment in each year. So now the investor choice, so that they invest in the stock or not. Another example from dividend growth model. Suppose TB Pirates Corporation is expected to pay a $2 dividend in 1 year. If the dividend is expected to grow at 5% per year and the required return is 20%, what is the price? So here in year 1, the dividend is $2. The dividend is expected to grow at 5% per year. Required return is 20%. Here you can see that the dividend is mentioned as 1 year dividend. It's not mentioned that it just paid dividend, current year dividend. So we have already got 1 year dividend. So D1. So if we can write that D1 equal to $2. Then divided by your required return are 4.20 minus your growth rate G, which is 5%, 0.05. So through calculating, we get here 13.33. So now again, I'm asking the student, why is not the $2 in the numerator multiplied by 1.05 in this example? Why it is not mentioned as 2 plus 1 plus 0.05? In our formula, we have already seen that D0 1 plus G divided by R minus G equal to D1 by R minus G. So here D1 equal to D0 1 plus G. If you know the current year dividend and as well as if you know the expected growth level, suppose your current year dividend is $2. Your current year dividend is $2, and it is expected to grow at 5%. So in year 2, how much it will be? It will be it will be 2 into 0.05 equal to 2.10. So similarly, here this $2 is already adjusted with growth percentage. This $2 is already adjusted with the growth percentage. So no need to calculate from D0 1 plus G divided by R minus G. The student may get confused over this confusion, over this complexity. Here we can see that stock price sensitivity to dividend growth. According to the graph, as the growth rate approaches the required return, the stock price increases dramatically. When your growth rate is 5%, when your growth rate is 5%, the stock price is about to $10. Is about $10. When your growth rate is 10%, then your stock price is about $20. When your growth rate is 15%, your stock price is about $40. So when growth rate increases, the stock price is also increased. So there is positive relationship between growth rate and stock price. For investors see that company's dividend growth rate is incremental, then the demand of this stock is also increased in the market. So when demand is increased in the market, the price is also increased. Stock price sensitivity to required return. Here you can see as the required return approaches the growth rate, the price increases dramatically. This graph is a mirror image of the previous one, where we have shown stock price sensitivity to growth rate. Here you can see that when growth rate is 25%, then stock price is $10. When stock price is 10%, when stock growth rate is 10%, then stock price is $40. So it just reflects the mirror image of the previous one. Example, Gordon Growth Company 1. Gordon Growth Company is expected to pay a dividend of $4 next period. And dividends are expected to grow at 6% per year. The required return is 16%. What is the current price? So here you can see that it mentions that the Gordon Growth Company is expected to pay a dividend of $4 in next period, and dividend growth rate is 6%. So when it mentioned that the dividend is for next period, that means it already adjusted with growth rate. So as like previous example, there should not be mentioned D01 plus G. So here we can directly mention 4 for D1. divided by your required return 16% minus growth rate 0.06. So it is $14. Remember that we already have dividend next year, expected dividend next year. So we don't multiply dividend by 1 plus G. Another example from Gordon Growth Company. What is the price expected to be in year 4? Following the previous example, here it is asked that what is the price expected to be year 4? So P4 is D4 1 plus G by R minus G. So price in year 4 is dividend in year 5 by return minus growth. So now we have to find out the price in year 4 based on dividend in year 4. So in year 4, it already mentioned that in year 4, the dividend is expected to pay as $4. So if we want to find out the dividend in year 5, then we can multiply it with expected growth rate 6%. So D4 1 plus G equal to D5. We can also write it as D1. D1 is first year dividend but into 1 plus G power 4. It should be power. Here same, it should be power. So your dividend in year 1 is 4 and your growth rate is 6, and you will multiply it 4 times in 4 years. So power 4 divided by 16 minus 0.06, and you will get price of the year 4 is 15.50. Since we have only year 1 dividend, so to find out the year 4 dividend, so to find out the price of year 4, we can put year 1 dividend and then we can power it by 4 to find out the year 5-year dividend in year 5. Now, what is the implied return given the change in price during the 4-year period? Similarly, to find out the implied return means your year 1 price and your year 4 price, and the difference, and the price difference, and which is denoted as percentage. So your year 4 price is, share price is 15.50, and year 1 share price, which you have already find out, which is $40. Then 1 plus return power 4. After calculating, you will get return as 6%. This is an example for non-constant growth. Suppose a firm is expected to increase dividend by 20% in 1 year, by 15% in 2 years. After that, dividend will increase at a rate of 5% per year indefinitely. If the last dividend was $1 and the required dividend is 20%, what is the price of the stock? Remember that we have to find the present value of all expected future dividends. So here it mentioned that a firm is expected to increase dividend by 20% in year 1, 15% in year 2. After that, it will increase 5% per year indefinitely. So in year 1 it is different, in year 2 it is different. Thereafter, in rest of the year, the growth rate is 5%. So if the last dividend was $1, the record dividend is 20%. What is the price of the stock? Now we have to find out the price of the stock. So according to the formula, D1 is D0 1 plus G. So here your D0 is 1 as per the question, and growth rate is 20% in year 1. Here you can see that growth rate is 20% in year 1. The last dividend was $1. So current dividend is $1 and growth rate in year 1 is 20%. So 1 is your current dividend. Then 1 plus 20% growth rate. If you multiply it, you will get 1.20 as dividend. Then dividend in year 2. We have already found out that dividend in year 1 is 1.20. So D1. So to find out the dividend in year 2, we can use formula like D1 1 plus G. Then we have D1, which is 1.20. Then multiply it with growth rate 1 plus 15% growth rate. In our question, we have seen that in year 2 the growth rate is 15%. So 1.15 multiply with D1, then you'll get 1.38 dividend for D2. Similarly, in D3, your D2 is 1.38. Then it is mentioned that after year 1 and year 2, the rest of the year will entertain 5% growth rate for dividend. So D2 multiply 1 plus 5% growth rate. Then your D3 is 1.449. It is needed to calculate P2. Now find the expected future price. According to the formula, P2 equal to D3 R minus G. Here in the question, it already mentioned that the dividend growth rate in year 1 is 20% and year 2 is 15%. And thereafter it will be increased in constant rate. So since it is it will be increased in constant rate, so it no need to identify the share price of every year after year 2. So once you know the share price in year 2, you can easily understand the share value and the share potentiality. So for this, when it will be mentioned that after a certain year the dividend will grow in constant rate, then you will count the last non-constant growth rate year for calculating share price. So here last non-constant growth rate year is year 2. After year 2, the growth rate is constant. So that is why now we'll find out the share price for year 2 equal to D3 R minus G. You should always remember that we are finding out the present value of expected future cash flow. So D3 is the future and P2 is the current. So here we are finding out the year 3 dividend value today. Year 3 dividend value today. So D3 is 1.449 divided by required return 20% minus growth rate 0.05. It is constant after year 2 equal to 9.66. So in year 2, the stock price will be $9.66. Then we can also find out the present value of the expected future cash flow. Using the 2-period example which we have already exercised in our previous slide, where D1 1 plus R for calculating year 1 dividend, D2 plus P2 divided by 1 plus R power 2 for calculating year 2 cash flow. So our D1 is 1.2 divided by 1 plus 20% growth plus year 2 dividend, which is 1.38, plus year 2 share price, selling price, which is $9.66, divided by 1 plus 2 power 2. Then you get 8.667 as current year share price. You can also do this calculation using financial calculator as mentioned in the below. Using the DCM to find R. Here R is required return, D01 plus G. D0 is current dividend, G is growth rate, P0 is current share price. So D1 by PO is the dividend yield and G is the capital gain. Suppose a firm's stock is selling for $10.50. It just paid a $1 dividend, and dividends are expected to grow at 5% per year. What is the required return? So using required return formula, D01 plus G, your D0, your current year dividend is $1. Your current dividend is $1 and its growth rate is 5%. 1 plus 5 equal to 1 plus 5% equal to 1.05 divided by current price. Your current price is 10.50. Then again plus growth rate. Then you will get required return 15%. Here you can also separately find out the dividend yield using dividend formula, capital gains yield using gains yield using capital gains yield formula, which is growth. So here required return is capital dividend yield plus capital gains yield. Stock valuation using multiples. Suppose a company had earnings per share of $3 over the past year. The industry average price earning ratio is 12. Then what will be the company's stock price? Here the formula is PT equal to benchmark price earning ratio into earning per share. So your price earning ratio is 12 and earning per share is $3. So you get here $36 stock price. So when every company mentions their earning per share, their price earning ratio in the annual report, so from this ratio you can easily find out to value the company's stock price. Investor normally do this for multiple year stock valuation, multiple stock valuation.